day, folks. Welcome to the next section on policy impact. Now, when we look at that, government policy, and that's what we're talking about here, can go into two different categories. Monetary, which impact the interest rates and money supply, and then there's fiscal, tax, and spending. So that's what happens from a financial perspective. That's just one. This is a really big piece, as we'll see moving forward. But what we look at is there's policy output and things actually done. What are they going to do to pursue the policies? And then there's the results, so output of what they're doing, and then there's the results. Okay? And these are consequences for our broad community, our society, intended and unintended. You can have a policy, and most of the time you may think you know what it does, but it will have unintended consequences. That can result from government action or, in many, many cases, just inaction. And the policy income is an amalgamation of these outputs and outcomes that come together. These are not just the financial ones that we talked about previously, but social actions. So when we go back to this, when we look at fiscal, both tax and spending, we can look at it within the context of, are we spending more than we're taking in? Okay, so if you're spending more than taking in, remember that adds into the GDP, which props up the GDP. Okay, but if expenses exceed revenue, it has to come from someplace. Okay, you have to borrow, and that's what we're doing with the U.S. government today, is that our expenses exceed our revenue. And at this point, it looks like it's just about $1 trillion this year. And this chart can see what happened between 2012 and 2019. So what we're seeing is this gap here is the budget gap. We're spending more than we're taking in, thus we're borrowing, and the national debt is growing. So that's the impact of some of these fiscal decisions right now, how we tax, how we spend. So as we look at that, we're going to look at trade, tax policy, healthcare, interest rates, oil, and there's many others that go in this category too. Let's start with tax policy, because if we come back up here, this is a key piece of fiscal policy. And if we start with that, there's really two aspects of tax policy. It's to generate revenue for the government to pay for expenses and projects. That's the first one. The second is to encourage certain behaviors by companies and individuals. They could incent us to spend money, whether that's individual or company, but the intent is to use taxes to cause or incent a behavior. And when we look at the tax reform that did occur, we can see that it did impact the GDP, but as we move forward, the spending and the tax no longer has that input. And that was a result for the 2018 tax year, is that for corporate tax rates went down. Okay. Now, for those of you, it used to be 15, 25, 34, 35, and it's now a flat tax. So those that make less than 50 are actually paying more, but the benefit really accrued to companies making this kind of money. Now, what you say, well, what does the company do with those savings? Well, the intent was for those companies to reinvest in property, plant, equipment, people. But what happened, that most of them went to pay dividends to shareholders, they bought back stocks, they paid off debt, increased cash. So it didn't result in as much of, it was intended to spur investment, and it did not do that. Next thing is trade. And a couple pieces of that. There's exchange rate, the value of one currency compared to another. Some of them are the market, and will fluctuate daily based on a willing buyer, willing seller. Other countries peg their rate to another one, a certain fixed amount relative to the dollar, for example. Now, from a U.S. perspective, the higher the value of the dollar means imports are cheaper for Americans, but exports from America are more expensive for other countries. So the dollar is very strong today because of our economy, and it's predicted to remain strong. So it'll impact the ability to trade. Now, trade agreements involve what can be traded and what taxes or tariffs are added. This is an unknown. This is what has the market uncertain. And this is why companies are considering, well, maybe we shouldn't make future investments in equipment and things of that nature because we don't know. The major risk in a trade is a trade war where each country taxes everything. But who pays for that? A tax, this tariff, is a tax paid on goods entering a country from another country. Okay? It's a percentage of value. The basic intent is to equalize costs between the two countries. Okay? So since it's paid when it enters the country, essentially the consumer pays for it. The trade war is when one company places a tariff on goods from one country and that country retaliates. Essentially, in my opinion, no one wins. But come back to this tax. Who's paying for it? It's paid when they enter the company by the importer and thus get passed along to you and I. The theory is instead of importing products at a lower cost, you produce them in the taxing country on the basis that it will create jobs, thus offsetting the higher cost. Now, this is still going on. We've been having this discussion for the past couple of years as to what is the impact of China, the trade war with China. Now, I'm doing this today on the Friday the 13th. So we may have a deal, we may not have a deal, but what we looked at is, this is the percentage drag on GDP from 2020 GDP from tariffs. And if you can see, tariffs were put on, they already put on those before September 1st. Then they put more tariffs on September 1st, more in October, and now the one in December. There's currently talk about not putting this one on, rolling back these. We'll have to see. But as you can see, if we have a GDP of around 2% and we're taking off, the tariffs are clearly dragging the economy down. Hopefully I will revise this and everything will be wonderful. Americans, when we look at this is a fascinating thing to me. Green is the survey. The question was, what do you think foreign trade means to America? Do you see foreign trade more as an opportunity for growth through increased U.S. exports or a threat to our economy? Now, go back and think about these mega trends that are happening in globalization, where sales are occurring, where growth is happening, and look at it within the context of the GDP. It's small. So most people, 74% today, believe there's opportunity for economic growth, where 21% view it as a threat. So you look at this, a threat is more jobs would move out, but then you got to take that into account. We don't have enough skilled workers. We're aging out. So all of these things start to come together. Next policy thing, and this is the ongoing discussion about health care in America, the Affordable Care Act. And the intent of that was to move to more of a prevention, lower cost-based model instead of an emergency response. Lower cost also results in better outcomes because the condition is being managed. Now, so if you can prevent a problem from happening, it's lower cost than getting an acute issue that requires hospitalization. And they're looking at that. It's easier to prevent diabetes than to treat it when it's out of control. So the focus was trying, how do we reduce the cost, but also reduce the human suffering at the same time? Now, a hospital has to treat you irrespective of your ability to pay. So if you come in, you don't have any insurance, they'll treat you. Okay, they're going to try to charge you, and that'll result in bankruptcies or other actions. So this Affordable Care Act was to make insurance available to everyone to move to more prevention-based. Some of the key things here: standardized definitions, including mental health and chemical dependency. Prior to the Affordable Care Act, every policy was different. You didn't know what was covered. So now for the different different plans, there now has to be standard definitions of what they're. Adult children covered till 26. Had we not had the Affordable Care Act, you would have had to procure your own health insurance because you were over the age of 18. The other thing is it can't be denied coverage because of pre-existing conditions. The policy direction is to eliminate this and implement something better that'll be cheaper, will live longer, etc. But it'll be great. We don't have any details on that, in my opinion. When you look about it right now, this is where people obtain health insurance right now. Employer and group plans, 46. Medicare, which is for the elderly. Everybody has to participate if you're over 65. Then there's Medicaid, which is for those meeting certain income. 7.2% are those that are Obama specific, and 8.4% uninsured. So we're looking at about 30 million people today, even with Obamacare, that do not have health insurance. But when they need treatment, they don't go to a doctor, they go to the emergency room because the emergency room has to treat you, and that's the most expensive thing. On average, wealthy countries spend less than we do in the U.S. So if we look here, the U.S. spends an average of $10,348, and we look at these other countries, and we can see that the average right here is $5,169. So we see costs are significantly lower. Now, that's great, right? So you would expect, if we're paying the most, that we should have the best healthcare system and with the best results. Let's take a look. Well, U.S. life expectancy, 81.2. OECD, developed countries, 78.8. Oh, we don't live as long. In fact, a study just came out that shows this number is declining while the rest of the world is increasing. Infant mortality, that's the number of deaths per number of deaths per 1,000 live births. Look who's on the bottom. Yep, 68% of population age 65 with 2 or more chronic conditions, 68% compared to other countries. Obesity rate, 35.3 versus 28.3. The good thing is we don't have as many smokers. Percent of population, we're not as old at that point. So as we look at this, we don't necessarily have the health outcomes, and that's sort of something we need to question. Why is it that more children die as infants in the U.S. Than most of the other developed countries? So the outcomes just aren't there. One of the things I think that's coming into play bigger and bigger, the percentage of opiate use by country. You can see that opiates are used by a significant portion of the population. Let's move on to oil and energy. What we see here, this is a graph that will take you actually back to 2010, and we saw oil up here in 11, well over 100. It held at 11 for about 100, and then it dropped down, and we've been has moved within a fairly narrow range over the past 3 years. Now, why is that? Well, I would suggest to you that there is a gap between production and consumption. So as soon as production goes above consumption, the price goes down. And when we have consumption going over production, prices go up. What seems to have happened is that some oil wells are profitable, and when the price of oil is $60, when the price of oil is $50, those wells aren't profitable and they don't produce. They won't sell it. So we're seeing this ability come on and off, and the oil supply, the forecast, when we look at it into this year, the consumption is not growing that much. In fact, we're moving to more sustainable energy. More electric is being produced by wind, solar, as opposed to liquid fuels, which include both gas and oil. So that gives you a sense of what's going on. Let's now take a look at interest rates. What drives them? Basic supply and demand. Going back to that very first slide we had here. The more money is in demand, the higher the rate. The lower the demand, the lower the price. The risk and return profile. The longer the term, the higher the rate. The shorter the term, the lower the rate. The greater the credit risk, the higher the rate. So the better credit gets the lower rate. Now think about this. This is not just for finance, but this is where the whole firm is going. So if I'm leading a firm, I have to understand that so I can make appropriate decisions. And when we look, this is a treasury yield curve, which shows short-term money, long-term. And if you look at the current, you can see that we're basically flat, then we go up. So we're starting to return to a more normal yield curve. When we go back to 17, we had a stronger yield curve. This had been inverted, meaning that short-term rates were higher than long-term rates. And when we look at the difference between the 10-year and the 1-year, it is narrowed. But if we go back to 1970 and look at that, any time that we've seen this spread go negative and reduce, we've had a recession. That doesn't mean one's coming, but a lot of people are focused on that. When we look at interest rates, we need to talk about it within the context of the monetary policy. And most countries have central banks. Some are very connected to the government, and some are independent, such as the Federal Reserve. Now, Congress oversees the Federal Reserve and appoints its governors. So what we have is a board of governors who govern the Federal Reserve banks, and they're independent. Then there's the Federal Open Markets Committee. These are a number of people from the Board of Governors and the Reserve banks who set policy. Policy is set by the Open Market Committee. What's the purpose of the Federal Reserve? It's really, they have two mandates: price stability, maximum employment. So that means they can engage in activities to achieve that. Stability means that the economy isn't experiencing high inflation or deflation. Experience and modeling has shown that economies perform well when inflation is low and expected to be low and predictable. This is what we have seen, and this is a University of Michigan inflation expectations, this was just the other day, and you can see that it's expected to remain relatively low at 2.2%. Not what we had back in the 80s and the early 90s. So what we've seen is a relatively stable inflation rate. What are the tools that the Federal Reserve has? Open market operations. They buy and sell treasury bonds to affect bank reserves. This is the main form of monetary policy. Discount window, which allows the Fed to lend banks money. Purpose is to manage that short-term Fed funds rate, which are the rates that banks charge each other for short-term loans, Fed funds rate. They can also require reserves to be held by banks. But these are all short-term. Long-term rates are set by the market. Well, what are some of the other policies that are there? Well, if we look, there's regulatory, that include environmental, safety. There's a long-term impact of these. And there's a lot of policies under review, a lot of them implemented in energy, healthcare, transportation, safety, a lot of things. So there's all these policies have a long-term impact. So what you do today will impact the future. There's so many of these, and this is where it's causing confusion and different political interests. So policy is very political, especially at this time in our history. What's going to happen going forward? What I see, based on, this is Moody's and another, I tend to agree with it. We're going to see, I think there's some risk of recession. I don't think we're going into one. Now think about recession though. That is going to implement, how is a company going to manage itself? I think we're going to see some global economic slowdown. Lower for longer interest rates. Interest rates continue to be extremely low. Trade tensions. I don't see that going away. Political risks. I think that's across the board in every company, every country. Disruptive technology. I think we're going to see digital technologies scale up and transform traditional business. This is huge. I think this is one of those macro trends that we're seeing. Climate risks. In my opinion, climate risk is big, but we're looking at the ESG, environmental, social, and governance impact. I think these things will be there in our economy, and that's what we'll be dealing with. Putting it together, cautious. I think we're going to have growth in our country and the world, but expect volatility and headwinds as things move forward. That produces an environment where things aren't real clear. And when things aren't very clear, we'll come to decision making. Decision makers don't like uncertainty. And that's some of the things we'll be talking about in the class. How does it relate to this course? Well, firms operate within an economic environment. The issues discussed impact the strategy the firms take and their ability to achieve their goals. This includes financial capital decisions and allocations, but human capital planning and actions. How do we recruit people, train people, retain people, compensation, performance management, etc. So these are all things that what we looked at impacts these because we're looking forward. Plans for production, including people and the use of technology. But how do they impact you personally? Number one, jobs. Predict jobs that will be in demand and it will enable you to focus on your skills development. The ability to you to support yourself and family. Quality of life issues. Ability to create wealth and planning for the future.